Choosing the right lender is a huge deal. It can literally mean the difference between having a good, smooth closing for a cheap price and a low interest rate, or having an expensive mess on your hands and potentially having your loan get outright denied. Having the wrong lender can cost you thousands of dollars and a potentially higher interest rate. So, how do you choose the right lender? Stick with me and I'm going to walk you through exactly that. Hey, what's up guys? I'm Ben Sun. Welcome to my channel. If you've been here before, welcome back. If this is your first time, welcome for the first time. I don't just talk about the potential disasters of having a bad lender. I also talk about things like personal finance, investing, and real estate. So if you're into that thing, tickle that big red subscribe button. So only about 75% of all borrowers' applications close, which if my math's correct, that means about 25% don't close. Now this could be for a ton of different reasons, but one of the major things is that the lender didn't adequately do their job ahead of time to prevent shortfalls. So it's critical that you get a lender that is going to work with you and know your specific situation. This is going to save you a lot of headache and it could potentially save you thousands of dollars. So how do you do that? So in the first part of this video, I'm going to give you some tips, some things to look out for, and some questions to ask the lenders that you're going to be talking to. And then in the second part of the video, I'm going to show you how to compare quotes so that you know you're actually getting the best deal. So let's jump into it. So first things first, you want to go in prepared. So you want to have a good idea of what your credit score actually is. In the description down below, I have a couple links to how to pull a free credit report. This will give you a good idea of what your credit score is, and it'll also give you a good idea of, is there anything negatively reporting on your credit report that you can take care of ahead of time so that you have a better credit score when actually applying for a mortgage. The other thing that you want to be prepared with is have at least a basic understanding of what the three major loan types are. Here's a little cheat sheet. I have videos on these that go more in depth if you want to learn more, but at least have a basic understanding so that you know what to look out for. And when a lender says, we have you pre-approved for an FHA mortgage, you'll know what that is. And then accompanying that is deciding whether or not you want to do a 10-year mortgage, a 15-year mortgage, a 20-year mortgage, or a 30-year mortgage. It's hard to compare rates because each one of those mortgages have a different rate. So if a lender pre-approves you for a 30-year mortgage and you're looking for a 15, it's hard to compare those rates lender to lender. So when you're talking to your lender, you want to make sure that they are all giving you a quote for, say, a 30-year mortgage or a 15-year mortgage. This is going to allow you to compare apples to apples. So now that you're prepared, plan on getting at least 3 to 5 quotes from different lenders. I would make sure one of them is like a local bank or a bank that you're already doing business with. They can offer you discounts that a mortgage company or an online company wouldn't be able to offer you. And then I would plan on getting a quote from a local mortgage company. You could ask your realtor if they know any, if you're working with a realtor. Mortgage companies and banks are going to have slightly different requirements and different closing costs. They each have their plus and minus, which I won't really get into in this video because it would be an hour-long video. And then if you wanted to, you could go to one of the big online companies. Getting 3 to 5 different quotes from slightly different lenders is going to give you a wide array of what to expect. Now, these lenders are all going to have similar questions, so once you get one quote, it's going to be easier to get the other ones because you're going to know what they're going to ask you and you can have those details prepared. An interesting statistic is that Freddie Mac found that borrowers who get 3 quotes tend to save about $1,500 on their mortgage, and borrowers that got 5 quotes tend to save about $3,000 on their mortgage. So each one of these lenders is going to want to do what's called a pre-qualification or pre-approval. That means that they're going to want to pull your credit. I personally wouldn't want 3 to 5 lenders all pulling my credit. It might give you the most accurate rate quote, but you can get a pretty accurate rate quote without having to go through the full pre-approval process. This is one of the advantages of the preparation that we talked about earlier, knowing your credit score, knowing what type of mortgage you want to do and what term mortgage you want to do. You can go and talk to them and not have to go through the full pre-approval process ahead of time. Again, it's not the end of the world and it's probably not going to hurt your credit score, but it will save you a lot of time and you'll still be able to adequately compare the quotes, which I'll show you in a minute. Once you narrow the lenders down, let's say once you have your top 2 lenders, then you can let each one of those do pre-quals so that you know you're getting the most accurate, up-to-date quote. So here are some things that you can ask when talking to the lenders. Ask them, you can go in and say something like, I have a 680 credit score and I'm looking to get a 30-year conventional mortgage. What would your interest rate be on that? Now, the other thing that you want to ask them are what are their costs? It's not just interest rate that makes a good mortgage, it's also closing costs. Some lenders can have low rate, high closing costs. Some lenders can have a higher rate, lower closing cost. And when we do the comparison in just a minute, I'll show you how to compare those two, because a low interest rate might not be the best deal for you. So you're gonna wanna ask what their closing costs are and what's included in those costs. And just as a quick refresh, closing costs are the costs for the mortgage company and the law office or title company to do your closing and prepare all the documents to make sure that the home is adequately in your name at closing. And these can be thousands of dollars, and they can vary greatly lender to lender. On average, you would expect between 3 and 6% of the purchase price, and that's a big variance. And on a couple $100,000 house, that can be thousands of dollars that one lender might charge that another wouldn't. Now, most of the time, a lender that has a low interest rate might have higher closing costs, or a lender that has a higher interest rate might have lower closing costs. So in our comparison, I'll show you how to manage that or what to look out for so that you know that you're getting the best deal. Now, when they quote you a rate, one of the things that you want to ask for is, are you paying points? Some lenders will quote a lower interest rate, but then charge you a fee called points. 1 point equals 1% of the loan amount. So you could get a quote that looks really good on the interest rate, but then they charge you 1% of your loan amount, which would be due at closing. And this is one of the biggest things that's often overlooked, and it can make it really difficult to compare quotes accurately. You want to know that you're comparing apples to apples. Also, as a side note, lenders will price match. A lot of people don't know that, and you have to ask for it. So once you narrow it down to a couple lenders, you can pit those lenders together to try to get the best price for the cheapest closing costs. All right, so let's jump into how do you quickly compare lenders. Now, a lender is going to give you what's called a closing disclosure or a loan estimate. It's going to look something like this. Obviously, I'll have something up on the screen. This is just for my notes, but this is a 3 to 5 page document, and it's got all the details about the loan or the estimate of your loan. So it's going to go over what the closing costs are, the interest rate, the down payment. All of these things are listed on this document, and you will get one of these from each lender because all lenders are required to give you something that looks pretty similar to this, if not exactly like this. Now, most of the information on here isn't super important for you to actually compare lender to lender, but there's a few things on each page that I want to go through. It's going to be pretty easy for you to look at it and say, this is the best lender for me. So let's go through page by page, and I'm going to tell you what to look for and how to choose the best lender for you. All right, so page 1 is going to have the pertinent loan details. So on the top corner here, it's going to say that it's a conventional loan or an FHA loan. It's going to tell you how long you're getting the loan for. If you go down to the loan terms at the top of page 1, it's going to tell you your loan amount and your interest rate. And this is the interest rate. We're going to talk about 2 interest rates. This is the interest rate that you pay based on the amount of money that you borrow. So I want to distinguish because we're going to be talking about 2 interest rates today. One's called the note rate. This is the interest rate that you're quoted. The note rate is the percent of interest that you pay on the money that you borrow. The other interest rate that we're going to talk about today, and I'm going to talk about that in just a second, is called the APR. And they're pretty different, but they're both pretty useful. And the APR is really useful when determining what lender to go with. I'll explain that more in a couple minutes. Then further down page 1, you get to your mortgage payment. Some of these include taxes and insurance. And then on the last part, and probably the most important part, on page 1 is your closing costs and how much you would need to bring into closing. Now, the closing costs are broken down into 2 sections. One section is loan costs, and that is how much the lender and the title company are charging you to do the closing. And then there are other costs, and these are going to be things that don't really change lender to lender. So you want to separate those out when you're shopping for a lender. The main thing that you're going to want to look at is loan costs. The other costs are important because someone has to pay those, but they don't change as much lender to lender because they're going to be things like your taxes and homeowners insurance and homeowners association dues, things like that are dependent on the home, not the lender. So you want to make sure that you split those out when you're shopping. And jumping over to page 2, you can see that these are broken out and they're actually itemized for you. So if you want to get nerdy about it, you could go line by line or you could look at the totals. One really important thing that's often missed, and one of the things that you really want to look for here is the lender charging you points? This is a fee or a credit to you for having the interest rate. So some lenders will charge you extra and quote you a lower interest rate, and some lenders will have a slightly higher interest rate but charge you less. This is where shopping is extremely important, and knowing how to compare lender to lender is really important. So if you're looking at a quote and you look at the top section in section A, it'll say percent points. In this example, it's 0.25 points or $105 that the lender's charging this person in order to have this interest rate. When you're comparing lender to lender, you want to get as close to zero, or you want to at least make sure that both lenders are charging the same points. What do I mean by this? I mean that if you go to page 2 and you see one of the lenders is charging you points and the other ones aren't, ask the lender that's charging you points what the interest rate would be with no points, or as little to no points as possible. This is going to be the easiest way to compare lender to lender rate, and what you'll see is that their rates are all pretty even. Again, a lot of lenders will instantly charge you money or charge you points and quote you a lower interest rate. That's perfectly fine and it's pretty common, but it makes the rate look lower than what it actually would be because you're paying to have that lower interest rate. And again, that's fine. You just want to make sure that all lenders are pretty equal when you're shopping them. And you want to factor in points into the closing costs, because if one lender is charging you points and another lender is not charging you points, then the lender that's charging you points is going to have higher fees than the lenders that don't. I know this can get kind of confusing. You just want to make sure that you're comparing apples to apples. So the best and easiest way to compare apples to apples is ask each lender what the interest rate would be if you don't pay any points. That way you can determine what the lowest interest rate is and what each lender's costs are without any point charges. So none of the other figures on page 2 are really all that important for comparing lender to lender. They're important for you to know what fees that you're going to be paying, but they're not super important when comparing what lender is better to go with, because again, a lot of these fees are going to be similar because it's based on the home that you're buying. The other really important thing that you want to look at, and one of the easiest ways to compare lenders, is going to be looking at the APR. And this is either going to be on page 3, 4, or 5 of your loan estimate. Remember earlier I said in the video that we're going to compare two rates. The second rate is your APR. The APR is the cost of the loan over the loan term expressed as an interest rate. So it makes it really easy to compare what the costs are. So for instance, let's say you went to your lenders, you had them all give you a rate quote based on the same points. And I would actually be pretty straightforward with the lenders and just say something like, can you send me an interest rate quote with me paying 0 points or as close to 0 points as possible? Again, that way you can easily compare lender to lender. Then when you get all of your quotes, you can look at the APR. That's going to tell you which loan is the least expensive. Obviously, the lower the APR, the lower the cost of the loan is. And so just to reiterate, because this can be kind of confusing, what you want to do is you want to shop for the lowest interest rate, obviously. You want to get your lenders to compare those interest rates based on 0 points or as close to 0 points as possible. That's going to allow you to better compare interest rate and how much each lender is charging for closing costs. And then you want to look at the APR to determine which loan is going to be the least expensive for you. Now that's all fine and dandy, but let's say one lender quotes you 5% and they have $5,000 in closing costs. And another lender quotes you 5.25%, but they only have $3,000 in closing costs. How do you determine which one is the better one to go with? So what you're going to want to do in this situation is calculate how long it's going to take to recuperate the closing cost difference. Because over a long period of time, having the lower interest rate is going to be more beneficial. But it partially depends on your particular situation, how long you plan on being in the home. Again, you don't have to factor all this in right now, but let's go with this example. Let's say our 5%, $5,000 closing cost example has a payment of $1,000 a month. And our 5.25%, $3,000 closing cost example has a payment of $900 a month. There's a $100 a month difference. So, and a $2,000 closing cost difference. So you can take 2,000 divided by 100, and that means that it's going to take you 20 months to break even or to start seeing a benefit of having that lower interest rate. If you're planning on staying in the home for more than 20 months, which I would say most people would, then that would be more beneficial to pay slightly extra to have that lower interest rate because, again, over a long period of time, a lower interest rate means that you're going to pay thousands of dollars less, or in some cases, hundreds of thousands of dollars less on your mortgage over a period of 15, 20, or 30 years. And then obviously, depending on what that number is, if you're not planning on staying in the home for as long as that number says, let's say it's a 10-year break-even point, then it would be more beneficial for you to pay less and take the slightly higher interest rate because, again, you wouldn't break even or you wouldn't see any benefit until after that period runs out. And guys, if you want any more specific clarification, comment down below and let me know. I try to answer all questions in the comments. So let me know if you have any specific questions, and that way I can get those answered for you. If you want to get slightly nerdy or be the most prepared, check out my mortgage playlist. I have a video covering basically every one of the major mortgage types. And then I also have a video on how to look for down payment assistance and get a truly zero down, zero out of pocket mortgage. And if you have any questions or a unique situation, please don't hesitate to comment down below. And if you got value out of this video, please hit that big red subscribe button, and we'll see you on the next one.